Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have a very special guest, a first-time guest, George Gammon. George is an American real estate investor and entrepreneur who produces his own YouTube channel. He lives part of the year in Medellin, Colombia, and also in the U.S. He manages a multi-million-dollar real estate portfolio. Welcome, George.
Hey, it's nice to be here. Thank you for having me.
Great. I thought we'd begin with a discussion on the economy. What are your thoughts on the economy, especially in the post-COVID era? Where do you see the challenges?
As far as the U.S. specifically?
Yeah, you can focus on the U.S., yep.
Well, I think that there's a lot of issues. I think if we start with understanding, going back to the GFC, that economic output went down by 6%, and that gave us the the global financial crisis. We go back to the Great Depression, and economic output went down by 25%. So that means that if we started at 100% output, the GFC took us down to 94%. And the Great Depression took us down to 75%. And I know just going back to March and April, a lot of people were saying that, well, yes, we've got COVID. Yes, it's bad. A lot of businesses are going to be closing down, and there's a lot of unemployment that's going to happen as a result. But if we could just get back up to, let's say, 75% of the economic output, there'd be kind of light at the end of the tunnel, and we could manage that. But they don't understand that optimistic approach would just be getting us back to where we were during the Depression of the 1930s. So people have to understand that you don't have to have a lot of economic, the output of the economy doesn't have to decrease by much to have significant ramifications on the standard of living of the everyday person out on the street. I think a lot of people get confused when they look at the stock market and they see it going to all-time highs because they assume that there's some sort of correlation between the stock market and the real economy. You would assume that would be true because supposedly those stocks or the stock prices should be a reflection of the underlying businesses and their ability to make profit. But as most of us know, unfortunately, that's not really true nowadays. It really has nothing to do with the underlying fundamentals, and it has everything to do with excess liquidity and capital flows. And I use the example of passive investing or these passive index funds, and what they do is they have no discretion whatsoever. They don't look at the fundamentals. They don't look at a PE. They don't look at a balance sheet or a P&L. All they'll do is if they have $1 come into the fund, then they have to buy XYZ stock at any price. Doesn't matter if the stock doubles, triples, quadruples. It's just at any price they have to buy. And the opposite would be true if $1 leaves the fund. If they have net outflows, then they have to sell at quite literally any price. So there's no discretion. There's no decision-making process. And I think that's exactly what we're seeing in the overall stock market. But the main point is the underlying economy, I think, is doing very poorly. I don't think that's a shocking statement by any means. I don't think that's controversial. All you have to do is just walk down to your local strip mall or the main drag in your local town and see how many restaurants and businesses are actually closed. And even if we got rid of COVID or the virus tomorrow, though a lot of those businesses, they're not coming back. I don't think people really understand that very well. Is that when you own a business and you run out of money, you're done. You're not coming back, even if the customers come back in a month or 2 months or 3 months. So I think you're going to see structural unemployment for a long time. And I think that it could lead to stagflation. And there's no certainties. There are only probabilities. But I think that if my base case, you got to ask me my base case, I think I see stagflation coming, which would mean high unemployment, would mean very low, if not negative growth in real terms. And then you've got kind of this economic malaise for quite a few years to come. Now, the prescription for that would be to get the economy going again. And the only way to do that is a bottoms-up approach. You have to have entrepreneurs going out there taking risk and trying to create more goods and services at cheaper prices and becoming more productive and more efficient. But if we have more regulations, if we have more taxes, it's going to get in the way of that quote-unquote recovery actually coming to fruition. And we may get recovery in the stock market, but that doesn't necessarily mean that we get a recovery in the real economy. So that's kind of how I see things right now.
Mm-hmm. And do you see continued stimulus by the Federal Reserve, the central bank, on monetary policy, as well as governments for fiscal stimulus ongoing?
I do, because I think the Fed knows the U.S. economy is based on three things. That's asset prices or asset bubbles, debt, and confidence. And one of those, I think the main key there is asset prices. So if the stock market goes down by, let's say, 25% or so, especially if it goes down quickly in an unorganized fashion, regardless of what Jerome Powell comes out and says on CNBC or in front of Congress, they're going to come in and try to create or do anything they can to give the market confidence or the individual participants confidence to come in and start buying again. And whether that's, I don't know how they could extend QE any further than they have, but whether it's buying stocks outright like the Bank of Japan has done, they're going to throw everything at it. Now, I'm under the belief that the Fed put might not be as strong as it has been in years past, because we go back to March, and if you recall, the Fed was supposed to have a meeting, I believe it was on a Wednesday, and they had an emergency meeting the Sunday prior where they dropped rates from 1% down to zero, so 100 basis points. And they announced QE infinity. They announced that they would basically commit an unlimited amount of money to the repo market if needed. The market opened up the next day and it went up for the first couple hours, but then it dropped and it ended up closing, I believe, over 1,000 points that day. So to me, that's kind of like the market saying, okay, well, now Fed, no matter what you do, we are not going to buy this Fed put anymore. There's a limit to the Fed put. And you'll notice what happened when the market started to go back up is when the government came out and actually announced that they would do a stimulus package. So to me, we've gone from a Fed put to a government put. And I think to answer your question, the Fed would come in and do whatever they thought they needed to do to prop up the market. I would include the housing market as well. But if that doesn't work, I think the government will come in and spend whatever they need to spend in the form of infrastructure or stimulus checks just to make the market turn around and go the other direction. Because at the end of the day, they're all talking to each other. I think it's nonsense to believe that there's this line in the sand between the Fed and the government. And they're on the phone, they're going to lunch, they're going to dinners together. And I'm sure Jerome Powell has, I don't want to say maybe instructed, but for lack of a better term, he's clued these politicians in on the fact that the economy is built around asset prices, debt, and confidence. And if they don't get on board with the asset component of that through stimulus, then the chances of them being reelected is very low, because we're going to go into a severe recession, if not depression. We're already in a severe recession, but we would go into a depression that would look a lot more like the 1930s. But I think that you might go into kind of an inflationary depression. So you've got the high unemployment that we talked about, the stagflation, but you have lower economic output while prices are going up. And especially consumer prices, that's where I'm most concerned, is the stuff that people buy on a day-to-day basis, such as food, healthcare, rent, housing. I think you could see asset prices come down, very similar to the way we had, or what we had in the early 1970s. Many people remember the inflation, of course, but they forget the fact that the stock market was in a huge bear market from 72 to 74. I believe it went down by almost 60% in nominal terms. So that's an example of a situation where we can have asset prices go down while consumer prices go up. But I think anything that would require a lot of debt, whether it's a car, a luxury item, those prices could come down or have a lot of headwind, while the consumer prices, such as food, what you're buying at the grocery store, that could go up substantially. I hope I'm wrong, but I don't see another way out of it. You've got to have a deleveraging. That's the bottom line. So whether that's a deflationary deleveraging or an inflationary deleveraging, that's really what we've got to pay the fiddler at some time. And that's the only way to do it.
Yeah, exactly. And given your earlier prescription for trying to generate more jobs through and also economic development through entrepreneurialism and maybe a review of the regulations, as you said, the excessive regulations, would the stimulus currently being provided monetarily and via fiscal stimulus by the government impede that process? Would that make things worse, if they're just creating, sustaining zombie companies?
Yeah, I think so, because you're talking about the confidence of the entrepreneur and willingness to take risk with your life savings. And when you're looking around you and you see the environment that's being propped up by stimulus checks, whether you understand economics or not, that's not a result of productivity. That's not a result of producing more goods and services. It's a result of money printing. And so I think anyone, even someone who, a teenager, even a child, would know that isn't sustainable. And therefore, you're not going to risk your life savings into something where you would need a healthy economy to do well. So I don't think that the Fed or the government is going to be able to pull the wool over anyone's eyes and try to get them to invest. And that's what this inflation target that the Fed has, supposedly that's what it's all about. They try to get inflation up to 2%, 3%, or whatever they're wanting to average. And they think, because of their models, that if we get this inflation, that means that the animal spirits have kicked in and that the banks are starting to lend and the entrepreneurs are starting to borrow and they're starting to create factories and build businesses and hire more employees. And therefore, you're going to have upward pressure on wages. But I don't think their models are correct. I think if you just look at the 1970s, we've shown many times that you can have significant inflation without there being additional economic output. So, but that's what they're basing everything on. And I don't think, I think we're at a point of no return, where in order to get the economy structurally sound again, I don't think that you're going to be able to do that starting where we are now. I think we're too far gone. I think you've got to have a reset or reorganization of the system, which would include a significant amount of pain, unfortunately. I hate to be negative, but that's just the way it is. What most people need to realize is that government right now is over 50% of GDP. So, think about that for a moment. If you have government spending over 50% of GDP, and as the economy gets worse and worse, the private sector, as a result of COVID, and the government has to step in with more and more money printing, they're going to become a greater and greater percentage of that GDP. Well, that means fewer and fewer goods and services are being created, most likely more and more regulation. And you take that to an extreme, well, what if the government was 100% of GDP? What would our economy look like? Well, we can go back to Russia and know exactly what that looks like. And that's not going to instill confidence in any entrepreneur wanting to go out there considering taking their life savings and putting it on the line by building a business and creating jobs. So we need to get that government spending down. We need to have the private sector a bigger portion of the economic output. If you go back to the early 1900s, especially before the Fed, ironically, you'll see that the private sector accounted for over 90% of economic output. And the government was maybe 5 to 10%. So that's the situation, or that's the type of economy you want. But you can't go from 50% down to 10% without going through an extreme amount of economic pain.
Hmm. And what do you make of the rise of millennial generation-based socialism and the calls for a universal basic income, and also a potential backlash from the disconnect between the financial markets and the real economy?
Well, I think that the anger of the millennial generation and the, let's say, the Occupy Wall Street crowd is justified. I mean, you've got this huge disparity between the rich and middle class, and it's growing, and we're kind of hollowing out the middle class. But their anger is pointed at Wall Street, and I think their anger should be pointed at Washington, D.C. I think they got to look at the government. So you can sit there. I think what they're doing is kind of looking at the symptom, and they're not diagnosing the underlying cause of what's created this environment. So I think that's only going to get worse, unfortunately, because the socialist narrative or the Marxist narrative, whatever you want to call it, is really that everything around us right now, everything that we have is a result of free market capitalism. I'm not sure how they connect those dots. That for me, that takes quite a bit of mental gymnastics, to say the least, because you look, and that's why whenever I use the word capitalism, I always like to use the word free market as well, because I think that paints a much clearer picture where the socialist type can say, well, look at the Fed stepping in and bailing out Wall Street in 2008, or look at them step in now and bail out all of these corporations that should go bust by buying junk debt or whatever they're doing. And they say, this is a result of capitalism. But if you say this is a result of free market capitalism, all of a sudden it doesn't make much sense. Because if we're dealing with a free market, but yet the Fed is coming out and bailing out these banks or corporations or American Airlines or buying junk debt, you're like, wait a minute, that's not a free market. That has nothing to do with the free market whatsoever. In fact, the free market would be the opposite of that, where we would sit back and we would watch creative destruction. Schumpeter's law or whatever, where you have the businesses and you actually let them go out of business. So the young entrepreneurs and the people who are more skilled, the people who are more prudent with their money can come in and take over the assets, and the economy gets stronger as a result. But what we're doing is we're propping up the weak, and we're not allowing that creative destruction to take place. I always look at it very much like the evolutionary process. When you look at the plains of Africa or whatever, you have the sick antelope, and that's what the lion is going to go after. And although it may be sad to watch it on TV or whatever, the bottom line is it's beneficial to the whole ecosystem. It's beneficial to the future, the gene pool of the antelopes or whatever. I know it's harsh to say, and we're dealing with humans, so of course it's different. But I think the economy is very similar, where you've got to let businesses go out of business, and it just makes the economy that much better in the future, and that increases the standard of living for everyone. Japan's another great example of that. It's really shocking that we kind of get hyper focused on the United States as Americans, and we almost ignore completely what's happened in Japan and other places in Europe, or especially in Japan. They've propped up all these companies for decades that should have gone out of business. And as a result, they just have just a slow grind downward in the entire economy. And they blame it on demographics. Yes, that's a big part of it. But in my opinion, it's more so a result of them just coming in and not letting businesses fail where they should have, and not allowing for this regenerative process to take place.
Mm-hmm, exactly. Given this backdrop and all of these challenges, where can investors go for protection or to invest in terms of asset classes? How do you see things playing out?
Well, what I do with my own portfolio is I break it down into three buckets. And the first bucket, I like to allocate 10%, the middle bucket 80%, and the final bucket 10%. So the buckets, the first one, for me, is just an insurance policy. So I'm just trying to protect my purchasing power, and that's just with physical gold. And for me, that's just kind of the obvious thing to do. With the middle portion, the 80%, I consider that investments. So by my definition, that would be something that pays you to own it. So it's not really something that you think is going to go up in price. It could, hopefully it does, but you've got to be paid to wait. So a rental property would be a good example of that. Maybe a dividend paying stock, maybe a bond. I wouldn't touch U.S. bonds, but maybe there's a bond out there, maybe a Russian bond that's inexpensive right now that you think is a good deal moving forward, and it's going to pay you to own it. That would be an example of what I would consider an investment. Then you've got the other 10%, which would be speculation. For me, that means it doesn't necessarily have to pay you. You're just buying it because you see extreme asymmetry. And Bitcoin would be a great example of that. A lot of people like to compare gold and Bitcoin to one another. I don't get it. I just don't get that. To me, it's like comparing, it's not even apples and oranges. It's like oranges and Ford pickup trucks. They're just completely separate. And for me, they just have a different purpose. So I don't see them as competitors. I don't know why you wouldn't own both, but you just have to realize that they're, one you're owning as an insurance policy and the other you're owning as a speculative asset. But also uranium, I think commodities right now are very cheap. And I'm one of those people that likes to buy things when they're cheap and sell them when they're expensive. I know that's kind of out of fashion right now. And a lot of people might say that way of investing is dead, but I for whatever reason, I still like doing it. So commodities are cheap right now, and I like to focus my attention there. That's kind of what I do for my own portfolio. So that's what I suggest people focus on as well. But that said, I'm guessing maybe a lot of your listeners might be traders, and this would not be applicable to them. I'm just a very, very long-term investor. I very rarely sell. Since I retired in 2012, that's when I started investing. I've purchased stocks maybe 2 or 3 times, and I don't think I've ever sold. If I have, I don't recall. It would have been a very, very small amount. But every time I bought, I just hold, because I just buy things when they're cheap, and then I don't even look at them. And then if I feel as though they're getting expensive, then I might go ahead and sell some of them. A good example of that would be real estate in 2012 in the United States. I went almost all in with real estate in the Midwest in right around the summer of 2012. And most of those properties, or a lot of them, I kept in a rental portfolio. And I held all the way up until maybe a couple of years ago. I still have a few of them. But I started to sell them a couple of years ago, not because I thought the market wouldn't continue to go up, but I was just sticking to my principles, not trying to time the market, but just asking myself the question first and foremost, is it cheap or is it expensive? And if it's cheap, I'm going to buy it. And if it's expensive, I'm going to sell it. So about 2 years ago, I came to the conclusion, well, now these houses are starting to get expensive. So I'm going to start selling them. And with the stocks that I have, although several of them have gone up, I've been very fortunate to make quite a bit of money as far as an ROI on those stocks that I've purchased. But none of them are getting to the point now where I'd consider them extremely expensive. And so I just keep them and just don't really pay any attention to them, to be honest with you. So I want to make sure that people understand that I'm not talking about it from a trading standpoint, just a very, very long-term investment standpoint.
Exactly. And for the commodity sector, where do you see those cheap, underappreciated value propositions? Or would that be like in agriculture and maybe industrial metals? Or
I like that. I like oil. I like oil a lot. I like uranium. And I know that the oil price has taken a hit lately and a lot of the producers are down, but to me, that's just an opportunity to buy them. I don't see in 5 years, as an example, the oil price being under 40. So for me, if you look at a chart, that's where I start, as a long-term historical chart adjusted for inflation, especially when we're talking about commodities. You'll see that when oil has gotten under $30 a barrel, it would be very cheap. And when it's gotten over $80 a barrel, it's been relatively expensive. So for me, that's just kind of the buy signal and the sell signal, and everything else in between that is just noise. So if you're just asking the question to yourself, do you think at some point in time over the next 5 years, oil is going to be over $80 a barrel? For me, that would be a yes answer. Now, again, there are no certainties, only probabilities, but I think the probability would be very high that would come to fruition, especially if your base case is a stagflation. And if that's the case, then buying it under 40, as long as you're buying a good solid producer with a good balance sheet, is going to be a prudent play. I wouldn't go in there and start buying shale producers or anything like that, but I would try to look around at value plays that are paying a good dividend, that are going to be there over the long term. They're going to be able to take advantage of a lot of supply destruction. And a lot of people, especially with oil, they get really hyper focused on the demand side of the equation. And I get it. Obviously, demand is going down, especially if what I'm talking about with COVID and the real economy plays out. But I don't think they're paying enough attention to the supply side of the equation. And if the supply side decreases faster than the demand, then prices still go up, even though demand's falling. So that's kind of why I see oil as a good long-term play. But again, the main reason is because I don't think that we're going to move to renewables anytime soon. Not saying that I'm against that, but I just don't think it's going to be completely realistic unless we want to take a huge hit to our standard of living across the entire world. And therefore, we're going to be stuck with oil for a while, at least the next 10 years. And in which case I like to buy it or a producer when it's under 40 or especially when it's under 30.
Well, great insight, George. How can our listeners learn more about your work?
Oh, you can just look me up on YouTube or Google my name or Twitter. Everything is under George Gammon. So it's George, typical spelling, and last name is Gammon.
Great. Thank you so much, George. Thank you.
Thank you for having me.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.